Good morning, everyone. Clifford Bennett, Chief Economist, ACY Securities. Hope you're all doing well and may the markets be kind to you today. We saw a big event last night. The Federal Reserve went on pause for the first time in quite a while and intimated, as we fully forecast. In fact, it looked a little bit like we wrote the script for the Federal Reserve Chairman and the Fed decision on the day, having for some time emphatically highlighted to everyone, all our viewers and readers, that the Fed would be probably going on pause, but would go out of its way to highlight it still has a tightening bias. And in fact, my forecast over the last several months has been for the rest of this year, we will see Fed rate hikes every second or third meeting. And that certainly fitted quite well with what the Fed came out with, which was their kind of, consensus forecast within the room, if you like, at the Fed is 5.6%, another couple of rate hikes. I think there could still be 3 rate hikes and the Fed could actually punch 6% by the end of this year. Now, I'm not saying that in a way that is excited on the good side of that. I think it's poor policy, but I do think it could happen, and it is a spectacular event, and therefore it will have market ramifications and generate tremendous opportunities. One of those opportunities may be that the equity market could be a little toppy here. I warned that the price action after the inflation data was cautionary, and I suggested, and I do see in the price action yesterday actually in New York, the market moved lower on the tightening bias signal, or really just initially even on the pause. So the market was already long, but then the market was bought back up, bit of a struggle there, it was heavy for quite a while, but it was bought back up, but not quite to, and then it consolidated just a little below really where it was trading before the Fed's announcement. That suggests to me that the buyers came in after the sell-off, the usual just buy any dip scenario type traders and investors and funds, they were active. But then the real selling began. And I do think the market is vulnerable here. Okay, if you want to take a totally unbiased view, because I have a biased view, and that is that US economy is in serious trouble as these rate hikes continue and inflation continues and going into even deeper dark bowels of debt, government debt continues, and there's a natural private tightening occurring of credit. Not a good outlook for the US economy. That therefore stocks could be a sell. That the US stock market could have come too far to the upside. Now, of course, I would say that because I've been a bear most of the year, neutral to bear most of the year. So of course I would say that. But at the same time, I think we can all see that the US economy is not in a good place, that the Federal Reserve is continuing to raise interest rates. I myself, I think, I dare to say, cross fingers, touch wood here, I've probably been the world's most accurate forecaster of the Federal Reserve for the last 2 years, forecasting very early on that they were making a mistake in not recognizing transitory inflation wasn't transitory, when the rest of the market agreed with the Fed actually at the time. And then I forecast they would have to raise rates too aggressively too late. And my forecast from about a year ago has been that the Fed could go as high as 6.5%, even 7.5%, and we're still on that trajectory. So having said that, I just feel that there is very much a disconnect between Wall Street and what's happening in Main Street, USA. That is a stretching of an elastic band between market sentiment and reality. And at some point it gets fully stretched and it snaps back. That's what I'm looking toward to happen on a medium to long-term basis here. What could happen that doesn't fit my view, but is also a possibility, is the elastic band breaks. But what would cause that? And what would cause that is an acceleration in the already expanding wealth gap in the United States. So the question could be posed, can the US stock market, US equities break free completely or permanently perhaps of the gravity of the situation for perhaps 50% of the American population, which is a lot more struggle and less luxury consumption than it is for the top 10, 20%, even 30% of the USA. In other words, there's always a differentiation within any society, and that isn't necessarily wrong. It's a natural state of the human existence. So I'm not criticizing that, and I'm not even criticizing acceleration in the wealth gap as long as the poor are getting richer as the rich are getting richer, which is what was happening before COVID. But since COVID, it's been very much a case of, or even perhaps a little bit earlier than that, it started to be a case of the rich getting richer, but the poor are getting poorer. That's when things break in terms of the social fabric. And we've already seen quite a lot of that. The stresses of that bursting forth in other forms, but that real stress of that wealth gap widening on rich getting richer, poor getting poorer is not sustainable. For the equity market, this could mean a split. So you get a kind of science fiction movie outcome of the inner cities and the rest. And the Federal Reserve and the Department of Treasury and the FDIC have already really established a ring fence around, New York and LA banks, and the rest of America won't get the full deposit guarantee. So, there are real practical implications of this process beginning to occur. And I think that is a diabolical, undesirable, but yet possible scenario for US stocks continuing to move higher on liquidity, and the rich having plenty of money to spend to maintain a core economy where some companies are booming, whilst much of the United States is really struggling. That's a terrible scenario. I really hope I'm wrong, but I always try to consider the full spectrum of possibilities before deciding one. I'm still going to stick with the idea that no, this elastic band will be pulled back at some point, and therefore I'm still a risk-off approach to equity markets. But it is something to keep in mind, especially as Fed funds rate may be hitting 6% by year end, but is certainly going higher, and I would suggest higher than that 5.6% or just another 2 meetings. The only thing that could stop the Fed hiking rates is for the banking crisis, which is indeed simmering in the background, to suddenly reappear with a vengeance. It's almost like the wild animal has been pushed back into the forest and everyone thinks it's come out, it's safe to come out and play. But it might just be growing and getting even bigger and stronger and could launch in and sweep away villages at any time. That's the US banking crisis. It is real, it is ongoing because of that ring fencing policy. So it's very much something to think about. Not very cheery news. Cheery news is we've got all the financial instruments we need to deal with this struggle going forward. I just want to highlight on the day that I would probably tend to go with the US 500 index or most stock indices today on a break of the range that we have seen in just the last 2 days, because that could be indicative of a several week, if not several month direction. So that's worth knowing. I hope that adds a little value. Have a good day. Thank you. Clifford Bennett.